let's talk a sector that hasn't gotten a lot of appreciation, but more guests have been citing it as a place to look as the market tries to rotate outside possibly of some of the big winners. Anthony Crowdell is joining as the Executive Director of Energy and Utilities Research at Mizuho Americas. So right now, it's pretty interesting, Anthony. Over the last couple weeks, I've had more of my guests start to talk utilities again. So walk me through the case right now. Does the sector, can it kind of graduate from the low rates and kind of bond proxy style of investing many knew about utilities for the last couple of years?
Good morning. We think so. If you think about utilities, average earnings growth is roughly 4 to 6%. On top of that, you get a very stable dividend. Average dividend yields right now are about 3.4, 3.5%. So you're getting kind of a risk-free return around 8 to 9% for some of the average growers, and some of the high growers like NextEra. We think it's great. You're going to get, high end of earnings growth, stable dividend yield, and NextEra is part of the ESG revolution. And I think they'll also continue to deploy more and more renewable capital, and they're getting this new ESG bid that's coming into our space. So we think the group is ready to rally beyond its bond proxy and widows and orphans kind of money.
So where right now then, is there kind of the most stable, because it's about stability, right? This is about trying to find companies that maybe you're not going to be fluctuating as much with the economic whims as we try and make this recovery. I mean, that's kind of the core thesis here, right? That these are stable.
Absolutely, and I think we've probably had a period of a couple years where we've had some names act non-utility, like you've had the big wildfires out in California and the filing of the PCG bankruptcy, which obviously investors, horrible story there. And then also, First Energy earlier this year also had some issues over some campaign contributions, and they also went down 40%. You had Portland General also had a rough go. So it's obvious, like you said, stability, preservation of capital. And we think the names that we like and we recommend, like NextEra, CenterPoint, and DTE, those are names that I think check the box, very stable, very great cash flows, great CapEx profile. And when you think of an NextEra that also takes part in this ESG revolution, and they're going to continue to win. They're one of the first companies building out wind resources across the country. And I think it was a nice article in the paper this week where their market cap has exceeded that now of ExxonMobil. So they're now at the forefront of energy. So we continue to like the sector and think that some of the names here, the quality names, have a lot more to go.
Two of the companies that we look at here, PCE, you mentioned, that's obviously been trying to make this kind of recovery and return to normalcy. When you look at the differences between these utility companies, are there those that also have potential revenue growth and market cap take, or anything that kind of goes on top and overlays on top of that regular cash flow? Are there any that have real growth here?
Sure. So if you think of utilities, obviously revenue growth matters, but if you think of how utilities earn money, it's based off of how much capital they invest, or we call it rate base. So if you find a utility that's in a good jurisdiction where they're looking to either build out renewables or build out some infrastructure, that's when you start seeing earnings growth. Obviously, then you're seeing revenue growth. If you think about when we had the blackout in 2003, after that you had this big push of infrastructure, and you saw the utilities really respond, grow earnings, grow rate base, and we have now more stable infrastructure. If you think about today, in a lot of states, they're looking to really push the renewable energy agenda, and a lot of the growth that you're seeing is within, green resources. You mentioned PCG, obviously there are other issues there with wildfire, but California's been at the forefront of renewable resources, and these companies have great CapEx profiles like Edison International, PCG, of fortifying the grid, but also in a green way. NextEra has been a leader in that, of building out the grid, and also name Alliant. We're neutral rated on Alliant, but Alliant also based in Wisconsin and Iowa. They're adding a lot of wind and solar resources to their network. And when you have regulators in each state looking to push the green energy agenda, utilities have responded, and I think they'll continue to respond. Even, Duke Energy, which is not a name that I think investors would put as ESG, they held a great ESG day last week. They're looking to retire most of their coal by 2030, and if the regulator is okay with it, they'll retire it all by 2030. So utilities respond to what the regulators want, and if the regulators are looking to keep going green, you'll see more infrastructure, you'll see more rate base, and in turn, you'll see more earnings, and as you brought up, more revenue. So we're positive on the sector.
Does this sector become a policy play? Does it now have expectations built in around next month's election? Does it seem like that in the stock prices? I mean, they've been pretty quiet for the most part. We've seen a lot more action in some of the specific energy companies. I mean, utilities have had a nice month here since October began. Are we baking in expectations that there's going to be a shift in leadership that is more energy, green energy specifically focused?
Well, we think a Biden win will help out the sector, or a Trump win will hurt the sector. Just, I think it's more of a momentary thing. If you think of how utilities are regulated, they're regulated by each different state. So when you follow utilities, you have to follow 51 different utility regulators. And I think while in the White House, if you had a leader who's pushing green energy and, green renewable energy benefits, that would clearly help the sector. But I think it comes down to also who's in the state house. And, if we just pick on my home state here, New York, if Andrew Cuomo's still looking to be progressive, green agenda and everything else, these utilities in New York State will respond and keep building, infrastructure. And if he wants green infrastructure, wants retirement of fossil generation, this will happen. So clearly it's a policy matters in our space. If Biden wins the White House, it will help our sector, but obviously don't neglect what goes on in each state house. And if you have a lot of states, Republican or Democrat, that really are looking to fortify the grid, create a lot of jobs, everything else, the utility sector is where investors could find some benefit.
Okay. One other thing, Anthony, just back to the specific story on PCG, PG&E. Are there any risks still lingering, skeletons in the closet, legal fees, or has that been understood by the market and covered by insurance?
It's understood by the market. Obviously they had insurance there. You saw legislation pass in California called AB 1054, which created a wildfire bill to help with people who've been hurt through the wildfires, to help make those payments. I mean, if you think about how this all started out in California, where they just had a different liability policy called inverse condemnation. And so basically, even if it wasn't the utility's fault, or even if they weren't negligent, they were liable for a fire damage. So if somebody was driving a car down a road and crashed into a pole and the wires fell and ignited a fire, the utility there was responsible. That's not the case in 49 other states. Although they haven't changed that liability, they have created this 1054, this AB 1054, which helps create a wildfire fund, helps distribute money, help people who are hurt by the wildfires, but it also maybe protects investors. Skeletons in the closets, not so much, but I think, two big issues there is, one, wildfire season probably goes on until end of November, I think early December. And if we've noticed, the wildfires the last couple of years have gotten worse as we've gotten more towards the end of the wildfire season, which is when, I guess, things are more dry, winds kicked up and stuff like that. The other thing for PCG investors would like clarity is right now you have an interim CFO and the company's looking for a CEO. So I think investors would like to see some clarity on who the management team will be. And then lastly, just circling back to the new AB 1054, I think investors would like to see the mechanism happen once. Somebody go through the process, although nobody's looking to see big wildfires and everything else. We just want to see the regulatory process of a company filing for claims that they paid out, looking for regulators to say those claims were prudent and the utilities' actions were prudent, and then to get recovery of that money. Until then, that may be, I don't want to say skeleton in a closet, but that may just be the overhang that exists in some of the California stocks. They're still spending, they're still growing rate base. We like PCG, we like Edison International. Sempra down south is Southern San Diego Gas and Electric and SoCal Edison. We're neutral there, but we think that they also have great CapEx profile. For Sempra, just more of a valuation thing. We think maybe it's fair value, but great growth story. California continues to look for utilities to grow their CapEx and rate base, and there's going to be some earnings growth there.
Okay. So looking for companies here with stable incomes, some maybe even expanding that, and then others reforming their old school ways to fit an ESG profile, all right? We will put utilities on our list here to watch over the next month. Appreciate you joining us, Anthony. Good stuff, making this group interesting. Utility stocks.
You bet, Oliver.
Thank you, sir. Anthony Crowdell joining us from Mizuho.